Well, so, I mean, why Bitcoin now, I think, is really the critical question. We are, with the election, entering an era of, I think, great uncertainty. In the next 6 months, things will settle and there will be kind of dust kicked up and eventually it will settle. Whether it will settle in the favor of people in this room is a question. No matter what happens with Trump's policies, whether they be good for the economy or bad for the economy, in both cases, we can expect pretty intense inflation, I think. And I think that's a wide consensus at this point. And so you would expect asset inflation in either case. And Bitcoin being a liquid market that operates 24/7, that is now going to be adopted by nation states, like the biggest economy in the world, the United States government, may adopt Bitcoin as a reserve asset in the next 100 days. You would think that Bitcoin would have a greater role on the balance sheets of institutions, central banks, pension funds, and so I think that's really we're at really this critical moment. And Bitcoin's historically volatile. It may continue to be volatile, or that volatility may start to become dampened, which I can explain as to why that could happen. But yeah, that's sort of where we are. We're sort of at this inflection point where it goes from a fringe asset to a guy was just elected partially on a Bitcoin platform and partially even funded by Bitcoin Wealth, which is pretty insane.
Yeah, that's pretty crazy. And we'll dive deep into that here in a second. And, well, not too deep, but we'll touch on it. All right, Jordan. So give us the why. Why are you in your asset class?
So real estate is an excellent creator and store of wealth, particularly today. On the private credit side, we're lending against assets that have a tremendous need for capital. Today, you've never seen such a discrepancy between the supply and demand for capital, with over $1.5 trillion of commercial real estate debt coming due over the next year and a half. And the regional banks who primarily provided that liquidity in the space, ultimately pulling out of the market. It's given the ability for groups like us to step in and fulfill that need, where we can generate outsized returns at very limited risk profiles against these assets, where typically we're lending against 60 to 70% of the asset value, but we're generating returns in the upper teens, even sometimes low 20% range. So the risk adjusted trade in real estate right now is probably greater than it's been in my entire career.
All right, Josephine, why your asset class? Why are you building homes?
Yeah, I think that Nashville is still very, very young.